Coindepo has been one of my pillars in my investment strategy already for quite a while, and although my portfolio has gone down, not because I've withdrawn, but because the coins I have deployed are worth less now, for example Bitcoin, it delivers and it delivers and delivers, so I have more Bitcoin on it now due to the interest, but it's currently worth less, but it's not a problem, it's just a waiting game until we reach better prices again. And one thing I was waiting for is the Q4 2025 report, which we released a couple of days ago. So let's check that one out. So this report is for the performance of the 1st of October 2025 until the last day in December. So basically the last 3 months. Like in the last report, we're going through each of the key points and have a look at what changed. So first of all, they managed to increase their assets under management by 22%, which now we have 270 million, or at least we had during this time in place when this report was made. So until the last of December, they have managed to grow their active users by 17.7%, and they increased their gross income by 22.6% to 13.3 million, which I think is very good. And probably the most important statistic is we have a net operational income of 0.35 million, so a positive value compared to the loss in Q3, which was mainly due to legal expenses that were one time and other stuff. If you're interested, you can check out my other video where I'm talking about the other report. Alright, the total capital allocated, so basically how much from the assets under management is 208 million, so also that grew by 22%, and the average annual yield per client is 16.1%. This is an interesting statistic because it either means more people are using the token advantage program to get more yield, or have opted in to use longer time frames, because this is basically the average on what people get on the platform. So for example, if you would get only stable coins for a year, you would get 23%. This is basically the number on average for everybody in Coindepo. I also said we reduced promotional spending and tighter operation discipline produced a positive net operational income of 0.35 million. So yes, we definitely reduced the bonus payments, the bonus programs, and I think with the active users and the growth of the active users, it speaks for itself that it is not longer required. And we also managed to put Coindepo on BingX, Weeks and Maxi. Although the token has not the most liquidity and not the most trading volume, I think it's safe to say it's an interesting token, at least for people using Coindepo and want to participate in the token advantage program. For a long-term holder without being able to use it on Coindepo, it's probably not that interesting. Next thing is a market overview. Well, it's basically saying, yeah, we are now in a more or less uncertain area because of the US policy changes and the US president and a lot of things that have happened. So this is something you can read yourself if you're interested in. The next very interesting part are again the financial and operations metrics. The assets under management we already had. So the liquidity and reserves are 9.13 million. So this also rose by 20%. It should have stayed around also the same as the assets under management have grown. At least that's what I would have liked to see, because this is basically what they have set aside for withdrawals. And if a lot of people would not need to withdraw now, directly now, it's a bit of a problem, but it is solved at another place. So the total capital allocated is now 208 million. So meaning this is the amount of money that is making them money. Active users, and that we already covered. The client interest payout were 8.75 million. This is quite a huge amount. And this is a cost here. The liquidator generator payments are 0.48. In the last report, we mentioned basically this is dependent on the asset under management. And this is basically, from what I understand, some entity that in case we need more liquidity from withdrawal than the 9.13 million provides the needed other liquidity. And just for that promise, let's say, it has a service fee. So they have, interestingly, reduced their operating expenses a little bit. The legal and licensing and compliance has gone down. Overall, they claim to have reduced marketing and stuff. This goes up a bit, but also probably have hired some new people. And impairments and professional fees have gone down significantly by almost 34%. This is probably for lawyers and stuff like that for the legal and compliance, although this is mentioned in a separate area down here. The next step is the investment portfolio overview. This is basically on what strategies or in what areas the assets are deployed and what kind of share does it make up from the overall 208 million. So their main focus is now the over-collateralized crypto lending, or was already in Q3, and they even increase it further. This is basically when you loan on their platform, from what I understand. The microcredit programs from the emerging markets, they scaled it down a bit. They wrote that they have a more focus on increasing security and reducing risk a bit, which I think is perfectly fine. So the results speak for themselves. Real estate-backed tokenized investments is almost staying the same. I cannot say anything about that because I have no idea how this is working and how the ROI in this case is, but apparently it's quite good. The market neutral trading strategies, so they increased it by 25%. So if they are able to pull it off to have market neutral trading strategies, and there are a lot of ways to do that, especially if you have a bit more money, I think that is very the way to go. Stablecoin yield strategies is interesting that this is being reduced because stablecoin yield strategies is, in my book, or at least from my understanding what it is, one of the safest. So for example, you have a liquidity pool, but maybe that's the next one, from two stable coins like USDC to USDT. Well, it's super safe, but also the ROI is not that great. The next one is exchange liquidity pools. This has increased by 21%, but I am not sure what the difference between an exchange liquidity pool and a DeFi liquidity pool is. But I guess some exchanges, so DEXs, are also providing liquidity pools compared to, for example, PancakeSwap and Uniswap and stuff like this. This would be DeFi liquidity pool. Reduced the DeFi liquidity exposure and increased the exchange liquidity exposure by almost the same margin. On the crypto asset allocation, you can see basically where the different crypto coins are. They increased their Bitcoin exposure a bit, reduced Ethereum, USDT stablecoin, XRP quite a lot, USDC stablecoins also a little bit, and they increased other assets, so probably something like Solana or Hype or I don't know, but that's definitely have been increasing. Portfolio return and metrics performance. So now we can see basically from the point we were talking before, where we deployed what and how that changed, we can now see basically the performance of those. So the over-collateralized crypto lending increased a little bit, so 20.8% ROI is something, is really good. The microcredit program has gone down a bit, so it's 33.5%. But I think it is very good, but I'm not sure about the risk profile of those, so I don't mind them reducing the exposure a little bit. The next one is the stablecoin yield strategies, which 14.6%. 14.6% is not bad, but considering, for example, that the payout I receive as a client when I, for example, use USDC on a year account is already 23%. This is below what I would receive, so it's still not bad, and it's still a stable anchor, I would say. Real estate-backed tokenized investments, 18.2%, also not that bad. Market neutral trading strategies, 24.8%. DeFi liquidity pools, 21.1%. I think here is room to grow. I've seen easily stuff in the 30s, but it depends on their risk profile and what we are doing. Exchange liquidity pools, as I said, I don't know exactly what it means. And the weighted average is 24.5% ROI. It goes down a bit, but this is also, they say, it's basically more deliberate risk discipline. So they are scaling down on the risk, and that's why it is 1% down. And I think that is still very great, because if you imagine all your money that you deploy is earning you 24.5% a year, or at least in this quarter, and the worst thing you need to pay is 23%. So if everybody had only stable coins, uses the longest duration, it would be 23% with the current interest rates. And we saw previously that the average is something 16 point something. So you are around 8% away, and that's more or less also where their money is coming from, that they earned. The next one are basically an explanation of why we are doing that, and it's basically to reduce risk and to set up for a more non-directional approach on what the market is doing, what policies are doing, and stuff like that. Next one is the user trust and growth. So we have the 102,000 users, we have over 200 million in assets, and we have 224 Trustpilot reviews with an average from 4.3 on the UK domain. We have 0 security incidents. Security incidents, yes, but there were definitely times when the platform was not reachable on the web interface. So definitely technical incidents were again there. Definitely less than in Q3, so this is definitely improved, but still problems at time. Or actually, I can only remember one. The other one was a planned downtime, which was announced way ahead, and I think this is the way to go, and this was executed perfectly from their side. So yeah, 0 security incidents, but technical incidents were happening. In this quarter, also the Coindepo token went live. It was listed on different platforms, and the token advantage program was also started. So this is all very cool things. And in the future, we want to do more. We want to, for example, also add governance functionality. And from what I've seen or read, more something like, for example, that you can vote on what additional coins are being added to the platform and stuff like this. Next is the risk management, security, and liquidity. So basically, what are the pain points that could lead to a problem? And they are saying basically we have 9.1 million in liquidity available, which nets around 4.2% of the assets under management. I am not sure what a good ratio would be here, but I'm trusting them, as we have also this liquidity provider service where we pay a fee for. We have 0 security incidents. And we are currently on the way of preparing to be able to, in the European market, to follow MiCA regulations. So this is a few stepping stones were made, which I think is very important to even gather more trust. Market visibility and positioning, yeah, that's a bit of PR and market blah blah, and yeah, it's something you want to see in such a report, but it's nothing substantial that helps us in any way. It's just a lot of nice words. The look ahead is basically also saying, yeah, okay, we want to further improve Coindepo token, and we want to increase the infrastructure without adding cost, and yeah, prepare to scale more without increasing the cost too much by scaling. Scaling always introduces some kind of cost, but we want to keep it in line. And the overall conclusion is basically it's gotten better. I mean, I'm surprised that it's almost 0.6 million difference to the last one. I hope that it would be positive, because in the last one there were a lot of one-offs due to legal and licensing stuff like that. And then this time they managed to net 0.53 million, which I think is a very, very good result. And I'm happy, at least from these numbers, the business model seems to be sustainable. One thing to notice, there is a lot of technical audits. So Sorted and more and Hacken. So they are, from the technical points, we are audited more than once for their technical security, but there has not been a financial audit done. So this is not externally verifiable. Other things that happened recently is they are increasing their board. So of advisors to help grow and grow and grow. And I had a quick look into the Nadja Bester, which was the latest addition to the advisory board. And it seems to a great way for having a more focused approach on how to address users, how to communicate, how to build a community, how to build a Web3 growth system, which I think is really cool. Looks like a smart person and a good fit to add. And the last thing, they promised to start burning tokens, and if you look into the tokenomics, they always say it was depending on the earnings. So we now know that they made 0.53 million, and they said they are investing around 20% of their earnings to buy back. And they just recently announced their buyback and burn program. And in this case, yes, they are committing 106,867 to buyback and burn. This will start from the 1st of April and it will go over 30 days because they do not want to move the markets too much. So they have an approach where we are going through the different exchanges and buying at certain times a certain amount of tokens. Nothing is announced here how we're doing it, because otherwise some could take advantage of that. And at the end, when we bought the 106,876, they are going to burn them, meaning probably sending them on an address that is not available or something like that. And then they will also release a report with the transaction hashes and so on and so forth. So this is really cool if this really happens, and I think it will. So I'm waiting eagerly when we are releasing that report that we can actually follow and see how much tokens are actually burned. I would think around 1.5 million, which is not too much considering they have 1 billion released, or the 1 billion will be released to the vesting. But the overall plan is to do this now every quarter, and until we burned a total of 500 million, so reduce the supply by 50%, which in theory should alone probably double the worth of each token you own. And let's see how much this will affect the prices of the Coindepo token. This first burn, I don't think that it will have too much of an effect on the price itself, but will be a good first test run to see that it's actually performed, that we can track it, that it's transparent, and that it's done. Yep, that's the look into the Q4 report with the burn and the advisory, and that's it all from my side. See you in the next one.